Hello friends, welcome to this new video. So today's topic is regarding portfolio allocation, and I thought why to make a video on this because whenever I present some stock, many times I'm asked about have you purchased it, have you sold it, how much you have purchased. So there are a lot of questions around it, and a stock name is just 10% of the game. The 90% of the game is about buying, holding, tracking, distributing, portfolio management, and a lot of things. So I thought, why not to make a video on just highlighting what is my overall style of investing, my own way of portfolio building, and where does any kind of stock which I present on YouTube that comes into picture. So let us go through it. And this is my way of doing it. It's not mandatory that this is the only way. There could be multiple ways. It may not be the best way, but this is what I do. So we will cover overall financial objective because any portfolio is incomplete without an objective. Then we will talk about my portfolio strategy. And then we will talk more about the equity portfolio guiding principles and where all the stocks which I present and all, where do they come in picture. So first thing, financial objective. And so I think any kind of financial exercise, there is no end to money and there is no end to return, and we need to define what is good or bad to us. And my belief is it should all start from the financial planning. So I'll not get into details of financial planning and how to do and what to do, but I will just highlight what is my financial objective, and equity is a part of that objective. So my financial objective is to achieve financial freedom at the age of around 45 to 50. The idea is not to have an exact line, but just a range by generating returns beating inflation by 100%. And I will come to why I'm taking these numbers and what is the assumption behind it on a longer term basis, which means I'm looking for inflation beating CAGR return on a 7-year basis. 1-2 years of return, I may not be that much bothered if it is higher or lower. And then at an overall portfolio level, which means equity is a part of portfolio, but there could be other asset classes, managing the drawdown with peace of mind, and peace of mind may be different for different people. So this is the qualitative definition of my investment objective, and below the numbers you see, which is more quantitative. So I'm assuming inflation to be at 6%, and the reason to be, this is your last 20 years of inflation chart. And if you see the inflation, it has been around 5 to 6%. So that is where I've taken an inflation of 6%. See, the idea is to have these numbers as guiding principle. I mean, there is no point in debating why this, why that, future could be different. The idea is to have a directional sense. So if the inflation is around 6%, I want to beat it by 100%. So my expected portfolio return is around 12%. And my expected drawdown is around 25%. Now you can say that market has fallen by 40%, 50%. Can I have peace of mind? No, I may not have peace of mind. It sounds very exciting to say buy when there is blood on the street, but at least going through 2 cycles, I can say that, it is a scary experience, and I would like to keep my drawdown at 25%. And the reason is I can see that there have been 2 instances, or in fact 3 instances, when the drawdown touched almost 40%. In fact, 4 instances in last 21 years. But overall, the drawdowns, the worst drawdowns every year stays around 20 to 30%, and some specific situations it goes to 40%. Personally, I would like to avoid those kind of situation. The other thing is why is this 12% reasonable? Some of you might think it's too low. For that, the analysis is, if we look at the US market and returns of US market in last 25 years across all asset classes, including large cap equity, small cap equity, bonds and golds and all, the average portfolio return has been around 7.3%. And if we compare Indian real GDP growth rate versus US, we can see that Indian GDP growth rate has been around 6.5% versus US 2.3%. So given Indian GDP growth rate is much more higher, I think the return expectation should be higher than this 7.3. This is almost 3. So I believe I could generate at around two times. Hence this 12%, and specifically for equity, I have taken around 15%. Which I feel is a reasonable number. Now, again, you might say that 15% aspiration for equity, then why are you individually investing in stock? Why don't you invest in mutual funds? My answer would be maybe mutual funds could generate, may not be. So what I have done is I have tried to take a random sample of 44 mutual fund data selected through large cap, small cap, mid cap, multi cap. And what we see is 5-year CAGR return of some of these mutual fund portfolio. And what we see is the mean return has been 15%. But out of those 44, only 13 mutual funds could generate and beat this 15% return. So I don't know out of 44 which 13 mutual fund is going to beat this 15%. So rather than selecting mutual funds, why don't I select the stocks myself and do it? Plus also I'm not averse to mutual fund. Index and ETF investing is part of my overall investing strategy, and we'll see more about it. And from a drawdown perspective, because I have restricted that 25% is something I would be comfortable, either I need to have a buy and sell strategy because I can't buy and hold, because if I hold it, I might see that 40% drawdown, or I need to allocate less to equity to have a desired asset level drawdown. So that is where I will try to manage both of them through a buy and sell and multi-asset level strategy, and both are part of my overall investment and portfolio philosophy. And I think this overall asset level 12% expected return and equity 15%, it's not over the roof and it's not lower either. I have given enough data proofs for the same. So with this, now let us look into the overall portfolio strategy which I follow. And again, see, the whole idea is to share more about my way of thinking and how I allocate to a stock. This is not the only way, and there could be multiple ways. This is what I am comfortable at, and this may not be the best way or as such. So we have option of first, what are the options we have to build a portfolio? So we have options along multiple asset classes: equity, gold, FD, PF, PPF, liquid funds, real estate, and all. So real estate I consider more for living purposes, and that is why I'm not even considering as investing, even though I do have some real estate exposure, but I am considering it as a non-investing portfolio. Then comes liquid fund, and you see the range 5 to 50%, which means at times it can go to 5%, at times it can go to 50%. Of course, the extreme numbers will be rare. It will be only for a certain duration of time, depending on the market extreme of over attractiveness or being over expensive. But in general, you can assume most of the times the number will be somewhere in the middle or lower side for this, maybe 10% or max 15%. But extreme situations, when I don't know what to buy, when everything is priced, it might go up to 50%. FDPF, PPF, this is something which is a normal due course of employee, and where you earn some money. Gold is also a part of strategy where at times I go between 0 to 10%, and all of this, it's not like I'm practicing it through last 5-10 years. The whole journey of building a portfolio strategy itself is a continuous journey and learning and evolvement. In fact, when I started, I never used to think about gold. So as the portfolio size grows, you need to think about how to balance it, how to manage the volatility, how to manage the risk. As you learn about multiple asset classes, you know how to leverage by churning and rotating the asset. And then 35 to 85% is equity. So you can see still equity is the most preferred asset class, and at time this is like the big asset class for me. But in equity also you have different options, like you can invest directly, take exposure to stock, or you can invest in index funds and ETFs, or you can invest in large cap stocks or mid and small cap stocks by market cap, or you can invest in India, or you can invest in abroad. Also in equity, you can participate by being an investor or being a trader. Or your approach could be a discretionary approach where you decide how to buy manually through a qualitative process, or you allow some kind of quantitative system to take the decisions for you. Or you can do on the basis of fundamental analysis and the valuation attractiveness and the margin of safety, or you can do a pure trade which is based on technical demand and supply. I differentiate a little bit between trading and investing. For me, trading means it is based on this kind of demand supply data of the technical through charts, whereas investing is more fundamental driven, but it's not for the time period. My investing could be of 6 months and my trading could be of 1 year. So I don't differentiate investing and trading in terms of time frame. I differentiate more in terms of what is the data point I'm picking to take my decision for that transaction. So you see, we have multiple options to build a portfolio strategy. and I will pick some of them and show what I have and how I do it. So first, my overall asset allocation and general philosophy across all these asset class. So FD, PF, PPF, this is 10 to 15%. And it's a passive allocation strategy based on that salaried income. Maybe last few months I have not been a salaried employee, but last 10, 15 years I have been, and this is how this portfolio has been built. Some of the initial years I did invest in the PPF. The idea is not to keep it more than 15% of the net worth and then let it grow at its own pace and not to touch it. Second is liquid. The purpose of liquid is basically to be the inversely correlated to equity portfolio. So whenever I feel equity is very risky and I book profit in equity, the liquid portfolio will increase with a purpose to invest it back into equity when there is a opportune time. So the idea is to keep it inversely correlated to equity. Only in extreme case, go to the higher limit to be touched, else it needs to be somewhere below 20%. The objective is to leverage the opportunistic equity buying. And I use PPFS liquid fund to, just park the money. The idea is not to generate extra 1% return, but the idea is to, utilize it to boost my equity return. Then is the gold, where off late I have built a strategy for gold and I am trying to invest as per that gold strategy. Again, the idea is to one, to diversify, second, to reduce the volatility, and third, to use that gold portfolio if equity is really very, very attractive and I run out of cash. So this is again based on certain kind of technical rules which which is based on gold chart based technical rules and relative attractiveness to equity. This strategy is longer term in nature, so it's not like a 2-3 month trade until the stop loss gets exit. But the strategy, the mean investing period itself has been 2 to 3 years, and I do it through gold-based ETF buying. No major reason. I feel comfortable if my stop losses get executed, and I utilize it only if the equity is really attractive and I have run out of cash. So this is I follow on the gold, and the equity, which is 35 to 85%, where most of the times I have seen it remains above 70%. And in the most attractive market, of course, it goes 85 because the rest of the things are in PPF and all, and there could be at least 2-3-5% of cash you need to maintain. And it goes 35 also only in extreme times, which I have not practiced, but based on all the learnings of last 2-3 cycles, I plan to do it. And that is why I said, it's not like I'm following it from last 10 years, but this is something which has been evolving, and I aspire to do it more and more, provided I can do it and I do have the skills to do it. And there are 3 strategies as a part of equity. One is a value stock strategy, and we'll talk more about it, but it's apparent that it's taking a direct stock level exposure based on some of the value investing principles. The second is a value index strategy, which is more on around the index funds and the ETF funds. And third is all the technical trades, where all the technical analysis and the quants and systematic trading, all of this come. And the value stock and value index strategy is based on buy and sell. It's not a buy and hold. So I don't plan to hold it forever or 5-10 year period. Again, see, a lot of things are based on the quantitative experiment and analysis and data analysis and my own qualitative experience, and based on what I am comfortable with. But I plan to buy and sell with the maximum holding period of 2 to 3 years based on whatever analysis I have done. And the trades are basically 1 to 20 weeks of trades. And this is basically the learning ground for the quants, where I try to learn new patterns of technical analysis or quants and convert into a rule or a system or an algorithm, and then try to do it in a systematic manner. So this is the overall asset allocation and guiding principle. Now we'll talk the most important thing, the equity guiding principle, because a lot of stocks which I present comes from this part, and especially it comes from this value stock portfolio. So I want to give a flavor of how I buy. It's not about just, studying a stock and going and taking a 5%, 10% position. I think there is a lot of method to the madness, at least what I do. So I'll just focus on this. So the value equity strategy, now this is the overall. So if you consider this whole equity exposure, which I have here, this is further divided into 3 parts. And this value equity is like around 30 to 60%. So you can assume on an average around 50% of overall portfolio. And this is based on the fundamental valuation, fundamental analysis based discretionary qualitative investing. heavily driven towards mid and small cap with a 10% cap on micro cap, and not any stock in a micro cap can go above 1.5 to 2%. What to buy in this? So I do buy here out of favor to fairly valued stocks or long runway stocks without any strict stop losses with condition, and we will discuss those condition. It's not a very strict stop loss, technical stop loss, but I do follow. We will discuss more about it. When to buy? So I use technicals for buying and selling, but it's not any kind of momentum investing. It is technicals which are used to avoid any kind of stage 4 stock, and we'll talk more about what is a stage 4 stock, what is a more stage 1 stock. So basically stage 4 stock is a stock which is in downtrend, and when they say don't catch a falling knife, I also believe that we should not try to catch a falling knife, and that is why I want to avoid the stage 4, and that is where I use technical analysis. Again, I can go wrong, I go wrong quite often. We'll see some examples, and I like to accumulate these stocks during late end of stage 4 or stage 1 or early stage 2. So there is not like exactly I will get only in stage 2 when momentum starting, because I believe still value investing provides that entry at stage 1 which does give decent return, provided we know what is the valuation, how attractive it is. So of course, when to buy, there is a whole fundamental analysis, but beyond the fundamental analysis, this is the technical analysis stage at which I like to take entry. How to buy? So, the stage 1 can last for even 6 months. It can last for even 1 year before the stage 2 starts. So stage 4 is basically your distribute falling stage where the stocks are falling and you keep losing money by averaging down. Stage 1 is the stage where stock stops falling, but it trades in a range for some time, which could be 3 months, which could be 1 year, or which could be 3-4 years also. And stage 2 is where the momentum starts and the stock starts generating return on a consistent basis. So the idea is to get more around stage 1 and early stage 2, and I try to buy it in a staggered manner over 3 to 12 month period based on the valuation range. So valuation is never an exact number for me. It is always a band, and that is why whenever I do a valuation exercise for a stock, you will see the band will move around 15% return possible, 20% return possible. Or some tweet I made regarding Sequent or in Newland, I mentioned that my band is between 1400 to 800 rupees, something of that sort. So valuation is a band, and the more it comes travels from the upper band to the lower band, I keep allocating in a staggered manner over 3 to 12 month period. So which means that I will not follow any kind of strict stop loss. So only when I have a lot of fundamental conviction over the valuation attractiveness, then I would like to get into this. But you could have stocks which always trade below, above 40p, and there is at least mentally I may not be able to justify. So how do I do it? So that is where I might have done a fundamental study, but I would like to take an entry with a strict stop loss. That okay, if it goes below, because many times we have seen stocks which used to trade at 80p, and when you look through history, it's obvious. ITC in 2015, it used to trade at 45p, and everybody could have justified. And now when it traded at 15p, people might say it's a stock which is even overvalued at 15. So this whole concept of valuation and the P, I think it changes with the season. So many times in stocks which don't correct beyond a certain valuation, and they're good stocks, good company, good runway, and that is where I told runway stocks, good runway stock, I might like to keep a strict stop loss and then play with it, given I like the fundamentals and good some 30-40% correction has happened. So that is why this stop loss thing, it applies depending on the fundamental attractiveness, but I would like to buy it over 3 to 12 month period, depending on the valuation range, depending on some of the key technical points, whether it is in stage 1 or stage 2. Or sometimes I might go wrong. I might have misinterpreted stage 1, stage 4 as stage 1, and we'll see examples. And then the time capacity to suffer. So I am willing to suffer for 1 year, but I can't suffer for 3-4 years telling that I have done value investment. So in 1 year, the stock has to go to stage 2. If it doesn't go, then I have done a mistake. So based on the technical stage progression, based on the valuation attractiveness, band progression, the time spent, all of this, I decide and I do a staggered buy. And as I said, it's a discretionary strategy. I can't define into rule when I will do it. It's more visual, it's more analysis. How much do I allocate in this? So in this portfolio, max 4 to 6% of allocation. So when I say this, if you assume this as a 100% allocation, I will allocate 4 to 6% allocation with higher conviction stock with quality. And there are times when the quality is not that great. I know it's not that great management, but everything else look good. I might allocate 1.5 to 3% depending on this through 3 to 5 tranches of staggered buying. So it's not like I got a stock and I go and I buy full 5%. It doesn't happen that way. At least I am not capable of doing that way. And this is how I try to safeguard myself. It might happen that some stock I took a 3% position. I never got a buying opportunity. I just kept going up and up and up. I don't worry about it. At least I'm not losing money. I'm getting money. So my idea is, my first objective is to protect money. And then if I am able to protect money, automatically it will grow. If I'm missing a multi-bagger, if I'm not allocating big, I'm not able to generate 30% kind of return, I'm totally fine with it. Because in my financial freedom philosophy, a 15% return will do. And with this way, I'm able to do it. So again, I'm not telling what is good, what is bad. This is what I do and I'm okay with it. Everybody needs to take their own call. And when and how do I sell it? So mean holding period remains around 12 to 36 months, depending on, you purchase and the stock is flying versus you spend 1 year and then the stock started moving. But I'm not a buy and hold guy. I don't hold forever, 5 year, 10 year. That is not my style. And I sell depending on the stock sector and market technical indicators for long-term investing. So technical indicators for long-term investing. So of course, valuation provides some guidance, but I've been many times wrong. I might have thought the stock is overvalued and stock keeps going up and up. It keeps surprising because of results and all. So I'm more comfortable selling technically, and their technical indicators become the primary sign and valuation becomes the secondary sign. And these technical indicators are more longer term in nature, which gives exit. So this is my overall value equity philosophy. And most of the stocks which I discuss on YouTube, or from a fundamental investing perspective, they fall here. I do have a ETF and index portfolio, which is 10 to 20%, where I may have the large cap, mid cap, small cap index funds, or NASDAQ ETFs to participate outside India, or some sectoral ETFs when I am very optimistic about the sector, but I may not have very strong opinion or very good research quality because I may not be expert in that sector. So I might like to go with a basket approach, and why not to buy the ETF itself. So I will not talk more about it, but this is another portfolio. And the third portfolio is basically the trade and quants technical portfolio. And technical doesn't always mean momentum investing. I apply technicals for reversal also. And by reversal, I mean the stock has fallen a lot and then it is trying to revive, or it has gone through a 30% correction. It might be still in a long-term bullish journey, but it's still in that journey, might have gone through a 30% correction and then it is trying to, reverse. Or it has gone through a major 70% correction, it is trying to reverse. So you can see the signs of what I use here. Similar kind of signs are used here also, but it's a pure trade. I'm not getting into fundamental. I might buy a stock where I care a shit about its fundamental. It might be a stock with high corporate governance issue, but I am safeguarding through strict stop loss. So all the momentum trading, all the reversal trading, or any kind of quantitative trading system where the inspiration comes by manually trading for a long time and then converting into a system, all of that happen here. And this portfolio remains 15 to 30% of my overall portfolio. And this is shorter in duration, where I get out within 1 to 10, 20 weeks. Some of them are trend-based system where it might run for 6-7 months. But some of the trades might be 2-week trades, which either give a 10-15% return, I'm happy and I exit, or maybe my 5-6% stop loss get trigger, I exit. Most of my stop losses are single-digit stop losses here. And that is how I try to buy, and max 1 to 2 tranche based on confirmation of visual confirmation. So this is more around trading. And let me give, because the focus is more around this, because this is where most of the question comes, the value equity portfolio. So I'll give you one example where how did I purchase it, and one successful and one failed one. So the successful one was Laurus Lab, and you can see that the Laurus Lab stock has fallen. This is stock split adjusted price. So the price fell from almost 100 rupee to 50 rupee here. which is almost a 50% correction and almost a 2-3 year correction, long correction. So this was the stage 4 correction phase. And this was the stage where almost for 1.5 years, the stock did nothing, but it just traded in a band. And if you look at the fundamental data, you will see huge capex happened during this period. The capex went almost 50-60% up. And the hint of this capex operating leverage was there in the con call. Through some network of friends who presented this stock, I got to know about this stock. In terms of tracking pharma sector, I also had my eye on this. And somewhere around this, I started adding the stock. So you can see, I started adding somewhere in October, but October to April, the stock did nothing. So there was almost a 8-9 month period when the stock, it did go up, come down, all of this happened. And then finally the stock story played out. So you can see, everybody has seen last 2 years of bull market. And when we don't get returns in 1 month, we start getting, crazy that, oh my God, it has not generated return. But you can see the kind of wait period which was there. 1 year wait period was there, and then only it started performing. And this was the stage 1, and I started participating somewhere in the middle of stage 1. And actually I exited this stock here itself. Again, it's all a learning. I mean, you can ask, okay, I missed all this return, but it's okay. I mean, again, I will say my objective is first not to lose money. And there is always a scope of improvement, improving the system, improving the rules for exit. But this is how I did it. So this was one successful bet, and you can see what is the stage 4, you can see what is the stage 1, and then the stock is flying, and this is stage 2, and stage 3 is one where distribution is happening. Now, again, for a long-term buy and hold investor, this all may not be valid. He might be looking at 20 year, but this suits my style of buy and sell, and hence this is what is relevant for me. The second idea which didn't work is, if some of you who follow me, you would have seen me tweeting about this stock called Johnson Hitachi some maybe 8, 9, 10 months back. And I'd never presented this stock in public. I never spoke much about this stock. But the idea was again to take position when something interesting is happening. I will not get into technical, but I thought this stock was in stage 1 post correction. And see, stage 1, 2, 3, 4, it's all time frame based. In a 2-year time frame versus 10-year time frame, what could be stage 2 could be stage 1. Again, I will discuss somewhere some other time. But stage 1 is basically after fall, the stock is consolidating, and I thought it is consolidating. I thought it is progress from stage 1 to stage 2 because the moving average convergence is happening. You can see the stop losses, the same lower lows are maintained, and slowly the stock is looking to form little high. This gap is reducing, and slowly you could see actually it was trying to break even from this point. And the moving average almost contracted, and then it went down, and there was a volume support also when this sell was happening. But finally, when it broke down, this was a high volume sell off, the moving average couldn't cross over. So it was an idea which I was extrapolating and taken that early position with 1.5% exposure into 1 or 2 tranches, and then it didn't work out. And valuation wise, still, if you see the stock even trades at 40-50 P. So P wise, it was never at that kind of attractive. And that is why I had a stop loss. And once the stop loss was broken, I took some single digit 7-8% stop loss, and I exited in loss. But it didn't turn out to be a big loss. And then the stock has gone down again. So this was one idea where the same thing, it didn't work out, but I could save based on the stop loss. And so this is how typically I do this. So whenever I present a stock, my suggestion, you need to do your own due diligence, you need to do your own research. But if you are interested to know how I am doing, this is the process which I follow. So there is not a very hard and fast system based rule for this. And few more things, the micro cap and the liquid stock, they can be very risky because few sellers can take the stock 40-50% down. So we need to be very, very cautious, and we need to take a call in the beginning itself, whether I want to go for a stop loss or I want to do a staggered buying by not exposing. And stock fair valuation range itself can move. This is not 405, this is 40% in a 30 to 40% band. Despite best abilities, at least I am not able to find the right valuation and time it based on this kind of valuation. Third, we need to decide in advance if we are going with the average down method or staggered allocation method, so that we have clarity of mind that how I am going to approach this opportunity. And fourth, things can change dynamically with another opportunity looking more attractive. So even though we might have a strategy in place, there could be another opportunity which could be very, very attractive and the capital is limited. So we might need to maybe book some loss and move. And I do all of this in that portfolio. So that is why I want to highlight. So it is ultimately our money is our money. We are obliged to do what we want, and nothing is a whatever I present, please note nowhere nothing remains a stock advice. And based on these principles, I keep churning, I keep rotating, or I keep adding, and one needs to take his own stand. But I thought I will just share how I do it so that it is useful to you, because too much of importance is given on social media about a stock that you told the stock or this is the stock price purchase, but stock name is just, it's not even 1/4 of the game. How it evolves, where that stock find a place in the equity portfolio, in the multiple equity portfolio, in the asset portfolio, in the overall personal and financial aspiration. So your financial aspiration, the rate you decide to achieve, and how do you distribute to the stock, to the equity asset classes, how do you take into equity, how do you accumulate a stock, how do you buy a stock, how you hold it, track it, how do you sell it, how do you manage your overall portfolio, how do you manage your own asset. All these things are very, very important, and that is where 80% of the effort is. So I hope this video is useful beyond all the typical stock based analysis. So do share what is your approach. If you want to put in the comment, do share if you felt this was useful, if you want to make more videos on these lines, or anything specific which I couldn't address and you want me to address. Thank you.